All right, let's jump right in. Today, we're going to look past all that daily market noise, the stuff that just clutters up your feed. Instead, we're going to dig into the real stories, the investment thesis behind six specific companies that one analyst is really watching for 2026.
So, what's really going on behind a stock's potential? I mean, is it just about the numbers on a spreadsheet, or is there a deeper story happening, something that maybe the market is overlooking? That's what we're going to get into today, the why behind all that potential. Okay, so we're about to explore the thinking behind these six stocks. And, gotta say the usual thing here, this is not financial advice, right? We're just breaking down the strategy, the logic from our source material, really just for educational purposes. We're trying to understand the why behind these picks.
And here they are, the companies on our list today. It's a pretty cool mix, right? We're going to start with a couple of tech giants you definitely know. Then we'll jump over to India to look at three really different companies, and we'll finish things off with a Latin American powerhouse. Should be fun. Let's do it.
All right, first section, we're talking about the tech giants and their next big move. We're looking at two of the biggest names out there and how they're handling some really important shifts in strategy, the kind of moves that could seriously shape their future.
So let's talk about Amazon for a second. There's been this puzzle. It's one of the Magnificent Seven, right? A total behemoth. But for a while, its stock was actually lagging behind the others. So what was going on? Why? Well, it all comes down to where they were putting their cash.
And this is the absolute core of the argument. It's all about a massive shift in their spending. You look back at the last cycle, and they were just dumping money into their retail and e-commerce side. Warehouses, delivery trucks, stuff that doesn't actually make a ton of profit. But now, it's a complete 180. The focus is squarely on their real moneymaker, Amazon Web Services, or AWS.
And this all boils down to one really important metric, return on invested capital, or ROIC. Basically, it's a report card for how smart a company is with its money. A higher ROIC is better, means you're getting more bang for your buck. Amazon's old spending, it was dragging that grade down. But now, by pouring money into the super profitable AWS, that grade should start to go way up. And this creates what the analyst calls a double engine effect. Not only do profits go up, but the market might start saying, hey, these profits are better quality, and be willing to pay more for them.
Okay, now let's switch gears to our other tech giant, Netflix. Their business model is honestly kind of beautiful in its simplicity. Think about it. They spend a ton of money to make a show, right? That's a fixed cost. But as they get more and more subscribers, that huge cost gets spread out over more and more people. So the cost per person keeps dropping, and the whole thing just gets more profitable.
So if the model is so great, why did this stock take a hit recently? Well, it was all these rumors about them buying Warner Brothers. In the short run, that's a tough pill to swallow. It means taking on a mountain of debt, a less efficient business, and it would definitely hurt that ROIC metric we were just talking about. But the long game, the real bet here, this could be the move that makes Netflix a true untouchable content monopoly. Okay, we're changing continents now. Let's head over to India, a market with just unbelievable growth potential. And we're going to look at three very different companies here, each tapping into the country's economic story in its own unique way.
First up is IDFC First Bank. And really, this chart says it all. Just look at its size, its market cap, compared to the absolute giants of Indian banking like ICICI and HDFC. It's tiny. And that's the whole idea right there. The argument is simple. The room for this bank to grow is just massive.
And listen, it's not just talk about potential. This is a huge vote of confidence from some very smart people. A major private equity fund, Warburg Pincus, just poured in almost 5,000 crore rupees. When the smart money makes a move that big, it's a powerful signal. It tells you they see some serious long-term value here. All right, next up, IEX, the Indian Energy Exchange. And wow, the story here starts with a bang. And not a good one. The stock got absolutely crushed, dropping 40% basically overnight. The news was something called market decoupling, which is a fancy way of saying its monopoly on power trading was about to disappear. Sounds like a total catastrophe, doesn't it? Well, hold on, not so fast. The other side of the coin, the big counterargument, is this. Yes, competition is coming, but the entire market for trading power in India is exploding. We're talking something like 15% growth every single year. So the thesis here is that a rising tide lifts all boats. The pie is getting so much bigger, so fast, that there's plenty of room for everyone to eat well, including IEX.
Okay, our last stop in India is PVR, the big movie theater chain. And to get the story here, you kind of have to understand this economic idea called a K-shaped recovery. It sounds complicated, but it's not. It just means that after an economic downturn, the wealthy get wealthier. And what do? They spend more on experiences, on premium entertainment, like a nice night out at the movies.
Now, if you look at PVR's bottom line, its net profit is still in the red. That's mostly because of some big acquisitions they made. But the number to watch here is earnings per share, or EPS, and you can see it's on a clear upward path. It went from way negative, and now it's getting really close to breaking even and turning positive. The market is just waiting for that moment, that flip into the black. That's the big catalyst everyone's looking for. Okay, for our last company, let's head down to Latin America. We're going to look at a real powerhouse in the region, one that gives investors a totally different way to tap into a huge global growth story. And that company is Mercado Libre, or MELI for short. Now, this isn't just one company, it's more like three massive businesses rolled into one incredible ecosystem. First, you've got the e-commerce side. They're basically the Amazon of Latin America. Then there's the fintech arm, a booming digital bank and payment system. And to top it all off, they have a super high-margin advertising business built right on top. It's a killer combination. I mean, look at this growth. It's just crazy. The numbers are staggering. We're talking year-over-year growth hitting as high as 77%. That is an insane rate of expansion. So you might be asking, why hasn't the stock just gone to the moon? And the answer is risk. The market is basically baking in all the economic and political uncertainty that comes with doing business in Latin America. And that brings us to the final part of the thesis for MELI. An investment here isn't just a bet on that wild growth. For a lot of people, it's also a strategic move. It's a hedge. It's a way to diversify your portfolio, to get some of your money working outside of the US stock market, which can be, very concentrated in just a few names. All right. Wow. We've covered a lot of ground, from Seattle to India to Latin America. So let's pull it all back together and do a quick recap. Let's look at the core story for all six of these companies side by side. Okay, here's the 30,000-foot view. For Amazon, it's all about shifting from low-profit retail to high-profit AWS to juice their returns. For Netflix, taking a short-term hit with a big deal to become the undisputed king of content for the long haul. For IDFC Bank, a simple story of a small fish in a giant pond with tons of room to grow. For IEX, the bet that a booming market is big enough for more than one winner. For PVR, riding the wave of luxury spending as it heads straight for profitability. And finally, for MELI, insane growth that also works as a smart way to diversify outside the US. So, when you boil it all down, the key takeaway is this. Behind every ticker symbol, there's a story. There's a narrative about where a company is going. Each one of these six companies has its own unique story of change, of growth, of strategy. So the real question for you to think about isn't just which stock is going to go up. It's which of these stories, which of these narratives do I think is actually going to unfold and come true by 2026? That's something to chew on. Thanks for tuning in.